Hey guys, it's me Dawson from Decoders. So in this session I'll be explaining on inflation. Let's start. So in the terms of economics, let me take my this thing, my pen. Yeah. So in the term of economics, inflation or less frequently price inflation is a general rise in the price of a level of an economy over the period of time. So when the general price level rises, each unit of the buying currency each unit of the currency buying few products and services. Consequently, inflation reflects a reduction in the purchasing power per unit of money, a loss of real value in the medium of exchange and the unit within the economy. So the opposite of the inflation is deflation. Now inflation, in the sense, to explain you slowly, you can take the example of petrol only. Like petrol prices during my childhood days, they were less. It was like 50 or 40 rupees. Today it's above 80 to 90. It's just crossed 100, to be honest. So that is called as inflation. That is the price gets increased over time. So it is a general rise in the price of the level of economy over the period of time. So inflation is there. So yeah, in simple terms it means like that. So when the general prices increases, the each unit of currency buying few goods and services, consequently inflation reflects a reduction in the purchasing power per unit of money. So it is like the real loss of exchange over time. So very high rates of inflation and hyperinflation are very harmful, sometimes ending in an economic collapse. So we can see, like, if inflation is increased to a very large extent, then we can see that it can cause an economic collapse, which economists believe can be caused by the increased growth of the money supply. So views on which the factors determine to low to moderate inflation are more varied. Low or moderate inflation may be attributed to the fluctuation in the real demand for goods and services during scarcities. However, the consensus of views of long sustained period of inflation is caused by money supplying growth faster than the rate of economic growth. So you can see the consequences also of hyperinflation, which is very dangerous. If the inflation prices increases too much, then it can cause a real collapse in the it can cause a real economic collapse. So you can see that the inflation also must be adjusted in properly, or else if it causes hyperinflation, then it's quite dangerous. So inflation affects the economist in various positive and in the negative ways. The negative influx of inflation can include an increase in the opportunity of cost of holding money, uncertainty over the future inflation, which may discourage investment and savings. And if the inflation were rapid enough, shortage of goods and consumers also began hoarding of the concern that the prices will increase over the future. Positive effects include such as reducing unemployment due to nominal wage rigidity, allowing the central bank allowing the central bank greater freedom in the carrying out of the monetary policy, encouraging loans and investments instead of money hoarding, and avoiding inefficiency associated with deflation. So you can see that the inflation affects the economies in various positive and negative ways. So negative in the sense it can cause of hoarding money, uncertainty of future inflation, so discouraging is investment and saving. So you can see like that only. So next we can study on the key takeaways. So inflation is the rate in which the value of the currency is falling and the consequently general level of price for goods and services is increasing. Inflation sometimes can be classified into three types, that is demand pull inflation, there is cost push inflation, and there is built-in inflation. So the most commonly used inflation indexes are CPI, that is the consumer price index, CPI, and WPI, which stands for the wholesale price index. So inflation can be viewed both in a positive or in a negative way, depending on the individual's just a second yeah depending on the individual's viewpoint and the rate of change. So those with the tangible assets like properties or stocked commodities may like seeing inflation as they raises the prices of their value of assets. So you can see that properties or like stock commodities can increase the value of their assets. So they yeah so to beat inflation, we usually invest in assets such as stocks or can be gold or anything. So to take the key takeaways, to we use the tangible assets like properties in the sense you might be buying a land, or you might be investing in REITs also, which is another kind of investment. So you're using that also for inflation. So understanding inflation, while it's easy to measure the price changes, just a second guys, yeah, while it's easy to measure the price increases of an individual products over a time, a human needs extend much beyond two or such products. Individual needs a bigger and diversified set of products as well as the host of services for living a comfortable life. They include commodities like food, grains, metal, fuel, and utilizing like electricity and transportation, and services like such as healthcare, entertainment, and labor. So while it is easy to measure the price increase of over the time, human needs to extend much beyond such as two products. So the commodity like food, grains, metal, utilities like this thing utilities like electricity and transportation, and services like healthcare and labor, so these are quite required. So inflation aims in measure of the overall impact of the price changes for a diversified set of products, and changes allows for a single value representation and increase of the price level of goods services in an economy over the period of time. So we can see that the overall impact of the price increase for the diversified set of products and services, and allows for a single value of representation of increasing of the over the time. So as currency loses its value, price increase. So what you can see is the money power gets depreciated over time. So the price increases, and it buys fewer products and services. This loss of purchasing power impacts the general cost of living for the common public, which ultimately leads to de- deceleration in the economic growth. So it can see that there is kind of a deceleration in the economic growth. The consensus view among the economists is that the sustained inflation occurs when the nation's money supply growth outpaces the economic growth. So to combat this, a country's appropriate monetary authorities such as central bank, that is the RBI, takes up the necessary measures to manage the supply of money and the credit to keep the inflation within the permissible limits and to keep the economy running smoothly. So for that reason, RBI has been formed as the Central Bank of India, that is the bank of banks. So it needs to adjust the monetary, the country's appointed monetary. It needs to adjust the measures also. So inflation is measured in the various ways of depending upon the types and the goods and services considering, and its opposite, and opposite of inflation is deflation. So inflation in the sense decreasing of the money power, whereas deflation is increasing of the money power. So you can see there is a two side. One side is inflation, another side is deflation, which is a general decline occurring when the inflation rate falls below 0%. So pros and cons of inflation are: inflation can be constructed in either in a good or a bad thing depending upon which one side takes or how rapidly change occurs. For example, individuals with tangible assets that are priced in currency like property or stock commodities may likely to see inflation, that is the raises the prices of the assets while higher rate. However, the buyers of such assets may not be happy with inflation as they will be required to shell out more money. Inflation indexed bonds are another popular option for investors for profit inflation. On the other hand, people holding assets such as denominated in currencies such as cash bonds may also see inflation as it erodes the real price of value of the holding. Investors looking to protect their portfolios from inflation should consider inflation hedged assets such as gold, commodity, and real estate. So you can see one thing is sure, like gold and stocks, they are oppositely attached. Like you can use gold as hedging with stocks. What happens is when the stock market crashed during the 2019 COVID-19, you can see the gold prices also increased over when the stock fell, the gold price also increased. So you can see that sometimes for hedging purpose you can even invest in golds and in stocks. So what happens is when you invest in gold, what happens is it creates an opposite kind of a refraction. Like if you take a crash, what happens is gold can go up. So that is the way, actually that is the way by which inflation can use. So you can see that it can be used as a hedging kind of a thing. So this was this was just a second. Okay, this was this part was stocks and this part was gold. So you can see clearly how hedging can work. Inflation promotes speculation, that is both by businesses and risky projects and by individuals in stock, as they expect better returns than the inflation. An optimal level of inflation is often promoted to encourage the spending of the certain extent instead of saving. If the purchasing power of the money falls over the time, then there may be a great incentive to spend now instead of saving and spending it later. It may increase in spending, which may boost the economic activities in a country. A balanced approach is through keeping the inflation value in the optimal and discernible range. So higher variable assets of inflation can impose major cost of an economy. Businesses, workers, and consumers must all account for the effects of the general rising prices in their buying, selling, and planning decisions. This introduces an additional source of uncertainty into the economy because they may guess it wrong about the rise of future inflation. Time and resources expected on researching, estimating, and adjusting economic behaviors are expected to rise in the general level of prices rather than the real economic fundamentals inevitably represents a cost to the economy as a whole. So causes of inflation are simple. There is a demand pull inflation. That the demand pull inflation is when the demand of the goods services increases but the supply remains the same. That is the pulling up the prices. So demand pull inflation can be caused by a few ways. In a healthy economy, people and the companies increasingly make more money. This is growing into the purchasing power, allowing the customers to buy more than they could before, increasing the competition for existing goods and raising prices. While companies attempt to ramp up the production on a smaller scale, demand pull inflation can be caused by the sudden popularity of certain products. For example, now let's start with the coronavirus pandemic. The increase in the demand for the indoor, socially distant activities combined with the highly anticipated release of the Animal Crossing, the New Horizons saw the price of the new Nintendo Switch gaming system almost double on the same secondary market because the Nintendo could not increase the production due to factory production halts from COVID-19. Nintendo could not release its supply to meet the rising consumer demand, resulting in increasing higher prices. So you can see that the Nintendo could not increase its production due to a factory production halts from COVID-19. So you can see the cause of inflation here. That is, the Nintendo could not raise its supply to meet its rising consumer demand, hence resulting in increasing higher prices. So next is cost pushed inflation. Cost pushed inflation is when the supply of goods or services limited in some way but the demand remains the same, pushing up the prices. Usually some sort of external event such as natural disaster hinders a company's ability to produce enough of certain goods to keep up with the consumer demand. This allows them to raise prices, resulting in inflation. For example, think about the oil prices. You and pretty much everyone else needs to a certain amount of gas to fuel your car. When the international treaties or the disasters drastically reduce the oil supply, the gas prices result because of the demand remains relatively stable as the supply shrinks. So you can see the oil prices also, like even now also the petrol prices are clearly increasing, and it's causing a huge impact to middle class people. And you can see that that is due to inflation also. Why? Because over the time, let me not get into politics, but I feel the price increase is this thing can be associated. There is another concept of oil bonds which was there during the UPA era government. I'll be doing a separate presentation on that. Let's move forward. So hedging against inflation. Stocks are considered to be the best hedging against inflation since the rise in the stock prices are inclusive of the efforts of the inflation. Since additions to the money supply in the virtually all modern economies involve as the bank credit injections through the financial system, most of the immediate effects of prices happen in the financial assets that are priced in currencies such as stocks. Additionally, special financial institutions exist where one can use to safeguard its property due against inflation. They include the Treasury Inflation Protection System (TIPS), low risk security investments such as indexed to inflation, where the principal amount invested is increased by the percentage of inflation. One can also opt for TIPS mutual fund or TIPS based, that is Treasury Inflation Protected Securities, and even exchange traded funds. I'll be making a separate video on exchange traded funds soon. To get the best access to stocks, ETFs or any other funds can help to avoid the dangers of inflation. You'll likely see a brokerage account. Choose a stockbroker can be tedious process due to the varied amount. So stockbroker, in the sense, nowadays we are having online discount brokers such as Zerodha, which I have used personally, like in 2000 this only 2020 2021 only. During February I started my this thing, and I think I have finished nearly 6 to 7 months in investing. But the knowledge which I have gained is of centuries worth of knowledge I have gained about investing. So you can learn more about companies and all those things. So share market is a very good area, and even this thing stocks also, it's a very good asset class in my opinion. You can use it to increase the this thing, like increase your this thing wealth over time. So gold also can be considered as a hedge against inflation, although this doesn't always appear to be case looking backward. So gold also is a very good asset, but thing is, gold also is kind of this thing, like the reason why gold is kind of sentimental is because we Indians love gold, and there is something called a sovereign gold bond, which I have made already a topic. So gold bonds are gold is also good, but gold is just a fixed asset, like such as the gold is, since gold is scarce, its value keeps on increasing over time. But to be honest, gold can be good hedging against stocks. So for hedging purpose for stock, gold is considered as a best option. But yeah, of course it can be hedged against inflation. Why? Because the average CAGR, that is the compounded annual growth rate of gold, is around 12%, 10 to 12%. So you can see gold is also kind of a good this thing. So inflation good or bad? So too much of inflation is generally considered to be bad for the economy, while too little inflation can also be considered harmful. So it needs to be adjusted properly. Many economists advocate for the middle ground, low to moderate inflation around 2% per year. Generally speaking, the higher inflation harms the savers because it erodes the purchasing power of the money that they have saved. However, it can benefit the borrowers because the inflation adjusted value of the outstanding debt shrinks to over time. So the CPI, that is the Consumer Price Index, is a measure by which examines the weighted average of the prices of the basket of goods and services which are our primary consumer needs. They include such as transportation, food and medical care. The CPI is calculated by taking the price changes for each item in the predetermined basket of goods and averaging them based on their relative weight in the whole basket. So the price in consideration are the general retail prices of each item as available for the purchase by the individual citizens. So the formula for measuring inflation is very simple. So the above mentioned price index can be used to calculate the value of inflation between two particular months. While a lot of ready-made inflation calculators are also available on the various financial portal and website, it is always better to be aware of the underlying methodology to ensure accuracy with a clear understanding of the calculation. Mathematically, if you want to find the percentage inflation rate, that is equal to the val final CPI index value divided by the initial CPI value into 100. So that is the percentage inflation rate formula. So today most economists favor a low and a steady rate of inflation. Low as opposed to zero inflation reduces the severity of the economic recession by enabling the labor market to adjust more quickly and in the downturn, and reduce the risk that a liquidity trap prevents in monetary policy from stabilizing the economy. The task of keeping the rate of inflation low and stable is usually given in the monetary authorities. Generally, these monetary authorities are the central banks that control the monetary policy through the setting of interest rates, through open market operations, and through the setting of the banking reserve requirements. So thank you guys, and a huge shout out to Vaishnavi from our finance department for making this PPT. Thanks a lot, Vaishnavi, and huge shout out. And guys, feel free to like, dislike, share, subscribe, and whatever. But one thing I would like to say, as usual, never stop learning. Thank you very much, guys.